So you want to make sure that you have a well-diversified Australian ETF in your portfolio? Well, that is exactly what we are going to talk about today. Welcome to Get Started Investing, the podcast where we cover everything that you need to know to start your investing journey. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm good, Bryce. Very excited for this episode. As Australian investors, one of the most common things we have in our portfolio, one of the first things we look to buy is an Australian ETF. Give us some diversified exposure to our home economy. And there are two very popular ETFs that track the Australian market in Australia. And today we are going to put them head to head.
That's it. This is a request that has come through from our listener, Varan.
Hey, equity mates. I'm new to investing and I've been learning heaps from Get Started Investing. So thanks. I'm starting to build my portfolio. I just wanted to make sure that I have a solid Australian exposure that's diversified across industries. I've heard you talk a lot about ETFs. I think that they'll be the way to go, but I want to keep my investments simple. The hardest thing for me at the moment is trying to choose which one. I've been looking at the VAS and the A200. Which do you think is better? Could you do a comparison of the two? Thanks.
Nice. Thank you for that, Varan. And as we said, Ren, two very popular ETFs. So just to clarify, we're looking at the Vanguard All Australia and the BetaShares A200.
Yes. So in this episode, we're going to quickly touch on why you might want to invest in Australia. Then we're going to compare the performance and the key stats of these two ETFs. And we'll talk about some of the other ones. But then I guess we'll close the episode by saying which of these ETFs we would be picking for our portfolio.
Nice.
So Bryce, this section probably doesn't need to be labored on much. It's the greatest market in the world. Everyone around the world should be investing in it. But why would you invest in Australia?
So Australia, we've got over 2,000 listed companies on the stock market. It's the 9th largest stock market in the world. But as you said, Ren, I think you can't shy away from the past performance. Since 1900, the Australian share market has returned a whopping 13% per annum, which does include reinvestment of dividends, because as a market, we also love paying dividends. I think it's the second highest market in the world in terms of paying dividends. So yeah, you can't look past performance, and of course, home country bias. There's plenty of great companies here in Australia to add to our portfolios.
So I think the key thing to stress is that after inflation, Australia has been a star performer. There's this book, Triumph of the Optimist, that looks at 101 years of stock market returns, 1900 to 2000 inclusive. Sweden, best performer, 7.6% a year after inflation. Second place, Australia, 7.5% per year. Third, South Africa, 6.8%. Then the USA in fourth at 6.7%.
Come on, US.
So Australia and Sweden, but Australia that we're talking about today has put numbers up. And the good thing is with ETFs, it's never been easier to get exposure to a diverse range of great Australian companies.
So let's get stuck into it and put our two ETFs head to head. We've got Vanguard Australian Shares Index ETF. The ticker is VAS, very popular in the Equity Mates community, as is our second one, the A200, which is BetaShares Australia 200 ETF.
I mean, for the sake of completeness, also very popular.
Also very popular,
community.
yes.
So to put them head to head, we've got 6 key categories. Index that it tracks. Secondly, the top 5 holdings and weightings. Then we've got fees. Fourth category is performance after fees. Fifth, distribution or dividend yield. And then finally, the unit price at the time of recording. So
Nice.
Let's get into it. 6 categories. Let's start at the top. Number 1, Vanguard v BetaShares Australian ETF, the index that it tracks.
Yeah, this is probably the most important thing that I think about when it comes to comparing these two ETFs, because they are slightly different. The Vanguard or VAS tracks the S&P ASX 300 index, which comprises 300 of the largest companies by market capitalization here in Australia. The BetaShares is in the name, the A200. It tracks the performance of the Selective Australia 200 index, which is the 200 largest companies by market cap on the ASX.
Yep.
So straight out of the gates, that is one of the major differences. You've got an extra 100 companies, for good or for bad, in the Vanguard ETF.
Yeah. Now, because both of these ETFs are market cap weighted, which means the bigger companies take up more of the ETF than the smaller companies, the extra 100 companies you get in the Vanguard ETF are all pretty small weightings.
Yes.
So both of these ETFs are driven by the big Australian companies, but it is worth noting that Vanguard is larger in terms of total positions, which leads us to our second point of comparison, top 5 holdings. And it won't surprise anyone to know that the biggest 5 companies are the same.
Yes.
Commonwealth Bank, BHP, CSL, National Australia Bank, Westpac.
Yeah.
So there's nothing interesting in that comparison.
I would go so far as to say the top 200 companies in both will be exactly the same.
That is a very good point, but we don't have time to read them all. What is interesting about this comparison, and it relates to the extra 100 companies in the Vanguard index, is that the percentage weightings, the amount of the ETF that's taken up by each of these companies, is larger with BetaShares.
Yeah.
And that is because the 100% ETF is spread across 200 stocks, sorted by size, rather than Vanguard, where it's spread across 300 stocks. Now, if that's a confusing explanation, the easiest way to illustrate it is with examples. So for BetaShares, Commonwealth Bank is 9.9% of the ETF at the time of recording, whereas for Vanguard, it's 9.3%. BHP is 8.6%. In BetaShares, it's 8.2% in Vanguard.
Yeah.
And that's because it's a bit more consolidated because there's less holdings, and it just means that the BetaShares ETF is driven a little bit more by those bigger companies, whereas the Vanguard ETF is driven a little bit less by the bigger companies and a little bit more by like the long tail of smaller companies in Australia. Well, smaller than these big boys.
Yeah.
They're still pretty big companies.
So that's the index they track, the top holdings. Now it's important that we have a look at the fees. So the cheaper of the two is BetaShares A200. It comes in at 0.04%, or in other words, for every $100, you're paying 4 cents. The VAS is 0.07%, or 7 cents for every 100 that you invest. So both of them ridiculously low cost.
Yeah, look, there's two ways to look at that. One, you could say BetaShares fees are almost half Vanguard's.
Yes.
And that is one way you could look at it. But yeah, 0.04, 0.07, they're both so small that for me, I'm not making my decision based on that.
Yeah.
Like they're both big ticks for me.
Yeah, I agree. Can't do much better, to be honest. So after fees, let's have a look at the performance. We'll start with VAS. Over the last 10 years, it's done just shy of 8% per year for 10 years. The last 5 years, it's done just over 8%. And since inception in 2009, it has done 9.21% every year since 2009.
Nice. Now, compare that to BetaShares. It was only launched in 2018, so we don't have 10-year numbers for this ETF. But the 5-year number for BetaShares, 8.5% compared to 8.1% for Vanguard over the 5 years. And then since inception, 9.3% per year for BetaShares versus the 9.2% per year, which you said for Vanguard. So BetaShares doing slightly better. Now, this relates to the BetaShares ETF being a little bit more consolidated, as we spoke about. And in Australia over that time period, those bigger Australian companies, Commonwealth Bank, BHP, they've done well.
Yeah.
And so having a little bit higher weighting to those big names has been good in that time period.
And slightly cheaper. To close out, as we said at the top, the Australian market pays healthy dividends compared to some of the other markets around the world. Both of these ETFs pay a distribution. Vanguard has paid 3.8% on average, and the A200 is 3.75% for BetaShares. So
rounded up, it's 3.8.
3.8. Yeah.
So, which is what you would expect, because all ETFs do is pass through the dividends from their underlying companies. If anything, you would have expected BetaShares to be slightly higher because they've got that slightly higher exposure to the big companies, and it's generally big companies that pay more dividends than the smaller companies. But you shouldn't be surprised that they're basically paying the same dividends.
Yeah.
So I think to just, we've still got one more point of comparison, but just to wrap it up here, they basically hold the same companies in quite similar weightings, have achieved quite similar performance, both charge incredibly low fees and both pay quite similar dividends. So we haven't really found a lot to split the two so far.
Yeah. So if you're stressing about it, just choose one and get on with it. End of episode.
Well, you might be jumping ahead. Let's get to the final bit of comparison, where there is a difference.
Yeah.
The unit price or the share price, but for ETFs we call it a unit price at the time of recording. Vanguard is trading at $102. BetaShares is trading at $137.
Yeah.
If they're exactly the same, why do they have different prices?
Well, you're going to have to tune into another episode to find out. No, this is just to do with at the time that ETF providers launch an ETF, they choose an arbitrary price at which to launch it. It could be $10, it could be $50. And then from there, the price moves in relation to the market.
Yeah.
So Vanguard's been around for longer, but BetaShares has obviously launched at a different price because it's slightly higher. So it has nothing to do with the underlying value of the ETF.
Yep.
It has nothing to do with the performance or one being better than the other. It's purely a function of how the ETF was launched.
Yeah, I think that's the most important thing. The fact that the unit price for BetaShares is higher is not an indication it's more valuable.
No, it's doing better at all.
But which one is right for your portfolio? That is what we are trying to answer today. Before we give the answer, for the sake of completeness, Bryce, just run through some of the other options that didn't quite make it into the ring today.
Yeah, well, Varan wasn't asking for us to compare others, but there are plenty out there, and I'm sure that there are some in the portfolios of the Equity Mates community. And these are from big global ETF players as well. So you've got SPDR, S&P ASX 200. The ticker is STW. It has fees of 0.05%, so actually slightly cheaper than VAS. You've got IOZ, a very popular one from iShares. It's the iShares Core S&P ASX 200 ETF. VanEck have an equal weight ETF. MVW is the ticker. Slightly different underlying structure, and it's more expensive at 0.35%, but still gives you access to the Australian market.
Now, just pausing there, I think it's worth noting that the equal weight ETF, because it's the bigger companies in Australia that have done better recently, the equal weight ETF has higher fees and has underperformed its peers. Yeah. Now, that's not to say that over time that underperformance will always be there, but Australia is a pretty top-heavy market, and it's worth just keeping in mind when you're thinking about your portfolio structure. And I know the question wasn't about IOZ or STW, but honestly, if you picked either of those two, it's not worth changing to one of the ones we're talking about today. They're all four of these Aussie index ETFs are great ETFs, and there are no bad choices, we should say.
Yes.
STW, IOZ, VAS, or A200. I would sleep comfortably at night with any of them in my portfolio. But Bryce, that wasn't the question, unfortunately.
The question was, which one would we be taking?
Yeah.
It's pretty clear for me. I would be putting in the A200.
Why is that?
Two reasons. One, we always talk about fees, and it's the lowest cost.
Yep.
I know we said, though, that there's not a huge difference, especially if you look at STW and IOZ, 0.05 compared to A200, 0.04. But if the option is there to take a lower cost and get the exact same thing, I'm going to take that. Secondly, if I'm comparing it directly with Vanguard's VAS, I like the slight concentration of the 200. I don't see much value in having the companies 201 to 300. Yeah. As you said a number of times, the value and the growth is driven by the top 20. So I don't feel a need to diversify even further to in fact get lesser performance.
Yeah. Love it. Well, look, for the sake of completeness, I'll take the other side of the fence.
Come
'cause
on.
I,
Come on.
I set up my auto investing with VAS because of the unit price.
Oh, yeah.
And the reason was I wanted to put $100 every time I got paid into an Aussie ETF. And because the BetaShares unit price was above $100 and we don't have fractional brokerage for Aussie shares, VAS made more sense for me. Unfortunately, VAS is now above $100 unit price. And so that logic has kind of gone out the window. I've stuck with it and just bumped up my auto invest. But to be honest, when I reset my auto invest and start again, it might not actually be A200 or VAS. It might actually be IOZ because its unit price is $33 a unit.
I think an STW is 73. So both of which you would be able to comfortably get a couple of units in at least. Yeah. Not that makes any difference if you're getting 1 unit, 2 units, 3 units, but you're investing the same amount, like you're effectively getting the same thing, unless you can't actually make the investment because of the unit price.
Yeah, all that matters is the dollar amount you invest and the fact that you are investing when we're talking about these Aussie ETFs. It's such an unsatisfying answer to be like, there's no bad options. People want a choice. Yeah. They want to be told that the choice they've made is right, or that like there is a clear best option. But unfortunately here, this is the dirty little secret in Australian finance and funds management. A lot of product issuers will issue products that are, if not identical, they are almost identical. And in this case, whichever one you buy, IOZ, STW, A200 or VAS, you're buying underlying exposure to the same group of Aussie companies that are going to move in very similar ways, and you're getting charged very similar fees for that access. So that's our unsatisfying answer for you.
Yeah, so thank you so much to Varan for the question. We hope that it answers it. And if anything, just get started. There are plenty of options that are all good options, as Ren just said. But keep the questions coming. We do really appreciate and love hearing from you. If you want to ask a question, we would love to hear a voice note. You'll find links in the show notes and description, and we'll make sure that we play it on the show. But that brings us to the end of Best ETFs 4. If you have a comparison that you'd like us to do, shoot it through as well. But Ren, as always, great to chat. We'll pick it up next episode.
Sounds good.